Ladies and gentlemen of the crypto space, we're live on Tuesday at 11:28 a.m. December 15th, middle of the month. What's going on? How's everyone's day? Hope everyone's good. Today's topic, adjust time horizon, how to think about investing. We need to reprogram what has been programmed in us, or likely not programmed in us by our institutional education systems, because we who got good financial education? Who's got a good financial education? I don't know who's got a good financial education. Sure as hell wasn't me. I didn't get it from school. I didn't get any of this from school. I had to figure this all out on my own way. Crypto chicks in the house. Always a pleasure. As the folks funnel in the room, I'm sure we'll get some great questions today. Today's episode, along with all episodes, is sponsored by Change Angel, the non-custodial swap exchange for social goods. Stop depositing on exchanges, not your keys, not your crypto. Non-custodial exchanges or DeFi. That's the only way to go. Let's pop it over to the main screen and see what's going on. So I like this topic. I talked with the blockchain babes about it a little bit briefly. It's about perception. And a lot of people feel that investing is a purchase. Like, oh, I have my money. And everything is from the perspective of money. The all special money. Oh my God, the dollars. I work so hard for my dollars. Fuck your dollars. It's not a purchase. You're not purchasing an asset. In fact, you're making a mistake by holding on to the dollars, because the dollars are the last bag that nobody wants to hold. If you go into a store and you want to make a purchase for an item, do you really want to spend your crypto? Would you spend gold? Would you spend a stock? No, you're going to spend dollars, because nobody cares about dollars. You can get more dollars. There's nothing special about dollars. In fact, there's something bad about dollars. It depreciates, it inflates, the value goes down. So you don't care if you get rid of them. Anyway, that's my opening monologue. Who else is in the room? Captain Weber's in the house. I'm on the Iris, Adam, DGB, time horizon. That's a good time horizon. Like what are you talking about? Iris is a good deal. Adam is wonderful. And DigiByte, these are great assets. Now, I was talking about this with the blockchain babes. These are highly speculative assets. These are high risk assets. And I myself know this from experience, because I put a fair amount of money into high risk assets back in 2016, 2017, and it didn't work out as planned. You get a 40-50% retrace in a high risk asset. I mean, look, we had an 80 something, 90% retrace in Bitcoin. Come on, guys. Even Bitcoin is relatively high risk, but Bitcoin is the risk off of the crypto space. And frankly, 2020 has changed everything, because it's not only just risk off. The smartest people on the planet, way smarter than me, have placed Bitcoin as part of the global financial macro narrative. So it obviously is an evolving narrative. But the reality is, it's not just risk off anymore in the crypto space. This has some serious story to what Bitcoin is. Now, clearly, there's serious story to some of these other assets. Like I literally just said shortly ago, that Aave is going to put serious pressure on the banking system in the next couple of years. That's a true statement. And what did we see with Bitcoin? 80, 90% retrade. There's no reason we can't see that with these other assets. So while you could turn $1,000 into $100,000 or $1,000,000, sure, if you're lucky. But you could also get unlucky in the other direction. So I would put everything but basically the high market cap assets, which is basically Ethereum and Bitcoin, in the high risk, high reward, high asymmetric return potential category, which means 1% of your portfolio, and that's all that you need. Who else is in the stream? Candid's in the house. Hans in the house. Always a pleasure, Hans. Yes, sir. Excuse me. We will go to the moon together, Candid. Jamie, best pulse in crypto. Thank you. I try. Well, my channel, Crypto Chick, is very much passive income, because as I talk about portfolio balance, portfolio allocations, time horizon, we're talking about the structure of a portfolio. And the goal of the portfolio isn't to liquidate assets, especially for dollars, especially for fiat. Sure, we have our speculative assets, our 1-2% plays, 0.5%, 0.1% in keep, rook, or even, well, curve's another story because that could easily be the forex of crypto for all we know in the next couple of years. But the point is, here, let's ramble off. I got a bunch of speculative assets. Polkadot. Although bear in mind, all of these assets that I have, aside from being speculative, produce recurring revenue streams. So it's a very complicated narrative to talk about, particularly because you can have price appreciation in Polkadot, but Polkadot's also inflationary, so it's producing yield. So would you liquidate? What's the point of liquidating if you could just take the yield and convert that into something get interest on it? So you're getting more Polkadot, which is in turn generating more yield, and then maybe you could lend Polkadot in addition to stake Polkadot. So I don't know, the same thing with Cosmos hubs, and the same thing with all the assets I've chosen. Synthetics produces yield. Aave produces yield with its security module. Obviously, Rook potentially produces yield. Loopring has a staking component which produces yield. Bancor has emissions and produces yield. As Captain Weber likes, is the Iris. I think Iris is potentially used speculatively, huge speculatively. Doesn't mean invest 50% of your portfolio in Iris, but look, it's exciting. It's hard. Listen, that's the thing. No mofomo. It's hard to not do what you want to do, but you have to remember your principles. You work too hard to take too much risk. So you can't over allocate a position size. That's the bottom line. That's the bottom line, boys and girls. Candid has YFI a future and yield farming has none. YFI Urine is potentially one of the biggest stories of 2020. What Andre created and Banteg and all the boys who built. They're very smart. You don't just do that. You don't just whip up smart contracts like that and start dominating the DeFi Lego space. So that's cool. And those are the types of folks that are nowadays the equivalent of the people doing startups in a garage. Back in the 80s, 90s, and whatever. That's like the Steve Jobs and those type of stories. That's what has happened in 2020 would evolve into. Andre and Urine and the boys who did 1inch at a hackathon, guys, you do see this as the startup in a garage relative to 2020. This is the new startup in a garage thing. It's what it is. In 10 years, these are going to be the big boys. These are going to be massive organizations, massive employers, massive revenue, massive yield, and a change of products and services that the general public has access to that produce meaningful financial products. Oh my God, this stuff is... Just get so angry at the status quo. The legacy financial products and services are so damn pathetic. It's like, can the products and services of Chase and HSBC and Bank of America be any more pathetic? Are they actually trying to produce actual garbage service and garbage products? Are they trying to destroy their business and not be competitive and just be, frankly, pieces of shit? Is that their intention? Chase, Bank of America, HSBC, and the 1,000 other banks? Is it your intention to just do nothing meaningful for people anymore? Suckering people into 30-year mortgages of debt and giving them no way to generate interest and no financial education on how to do the right things with your money. Oh yeah, just give us your money. We'll give you 0.02% interest. And here you could borrow 300 grand for 3.5% interest for 30 years. So you're stuck paying us for 30 years, and we'll give you no money in the meantime. Whatever. That's just me getting angry. You guys know me. So the intro was time horizons and how to think about investing. I really like that. I want to go over to the Bitcoin chart and do a couple of other things, but I want to reaffirm that statement. You're not buying an asset. You're not purchasing Bitcoin. You're converting value from one store to another. And the fallacy is if you're buying Bitcoin, it could go up or down in price. No. The fallacy there is you could buy dollars and it could go up and down in purchasing power. The fallacy is that dollars, you don't give a shit how many you have. I've said this before. It's how much purchasing power you have. And that's always fluctuating. So the lie that everyone tells to themselves is that you have a fixed quantity of money and it's unchanging and you can't lose it. Meanwhile, every second of every day, you're losing purchasing power, and that's really all you care about psychologically. So, fiat is a system of control, and the banks, the status quo, they trick you, or maybe they lie to you, and it's malicious and not just. Maybe it's bad intention, malintention, to make people think that they're they're storing their value in the right place. And it's just wrong. It's a fallacy. And maybe whether it's intentional or not, it is what it is now. And we see that only because there's an alternative and there's competition. When's the last time there was competition in the banking sector? Never. This is the first time in the history of the planet that the general public could create software that's competitive with the banks. And that's what's occurring. And we finally, in 2020, started to see some brave entrepreneurs, some very brave folks. Was it the boys out in Switzerland, Cresco Finn? Is that what it is? And obviously Mashinsky with Celsius, and Zach with BlockFi, and Nexo Finance, and there's a bunch of them. There's Voyager, but it's going to be an explosion, boys and girls. You know why? Was it Circle that's offering interest now using Yearn products? Oh my God! So they could offer something that banks can't. So now all of a sudden, companies are competing for basically trillions of dollars worth of deposits to generate revenue off of. Because if Circle can make 15% and give someone 10%, the person is going to be highly incentivized to reallocate their funds towards Circle. Circle will be making 5% yield. The person will be making 10% yield. And the net result is the person thinking Bank of America was a piece of shit all these years. Ain't that the truth, ladies and gentlemen? We're in a time of realization. Realization that things have to change. And if they don't, people are going to force them to change. It's the beauty of technological evolution. Let's take a look at the Bitcoin chart. I got it up here. So this is what was fascinating, what I just noticed. A tweet that I posted just before I jumped on the stream. Our resistance, and obviously the support. So the resistance right now is the purple line, and the support is the orange line. And that's cool, because here we breached support, we hit resistance on the purple line, but the purple line is basically the top here. So I drew the purple line at the top here. So that's your previous local top. But it fell through. It's like the orange line did not hold support. And the orange line, if you go back to the weekly, was resistance, December 18th, 2017. Multi-year resistance. So the orange line did not hold as support here. It held as resistance here. It also failed as support here. But this is different price action. Look at the price action. I know it's subtle and I know it's relatively short time frames, but this is quite different price action. You had a breach to the upside. You had a retest with downward price action, which held as support. We have a doji here, which also held above the line, the price action of support. This is obviously the 30-minute. But if you look at the 30-minute, the amount of times, look at all the wicks. Look at the 1, 2, 3, 4, 5, 6 wicks. 6 wicks went below the orange line. How many wicks went below the orange line here? It was you had the breach, then you had 1 and 2, and then you had your upward price action. Here you had It's not consistent. It's not 6 wicks in a row of support being held on the 30 min. So it's a relatively short time frame, so this doesn't have great meaning in the long term. But what's notable to me, what catches my eye, it's very different price action as compared to the two previous times we breached the orange line to the upside. Now, bear in mind, this is the first time we've breached the orange line to the upside in a long time, in years, so to speak, since 2017. So we're in price territory that's unprecedented. It was precedented one time before. This was nice support back here. So this looks good. Man, I think we're going to hold here for a bit. I think we're going to hold horizontal. And it's nice to see it above the purple line, but if we see a break above the purple line, at least a new higher high, what we look for is this. What we look for is this, boys and girls. Blue, blue, and then a fall. So this is the support right here, a previous high, resistance flip support, and then you want to break a new higher high, and that's the name of the game. And that's what you look for, and that's how you could be bullish, and that's how I could go on Twitter and say, yeah, the odds are we're going to have bullish price appreciation. And that's when people are like, oh, Noah was right. Noah's tweets were right. It went up because there was confluence that it's going to go up. There's a higher likelihood than less likelihood for it to go up. And in a situation like that, if it goes down, you're like, huh? Why did it go down? It would be an aberration, something that was not expected, something anomalous, so to speak. All right. I did mention before I jumped on Twitter about Aave. Love Aave. It's a big deal in the next couple of years, and it's setting the stage for the lending and the collateralization process, and using assets and accessing the equity stored in the assets, and that's really what they're setting up, establishing as a functional concept. And it's the same thing with compounds, the same thing with MakerDAO, though MakerDAO does it quite differently, um, because they created an asset. They literally created DAI. DAI comes from MakerDAO. Whereas with Aave, when you provide collateral, you could have a debt position in any of these assets. That's not the case with MakerDAO. The only thing you can have a debt position with is DAI. But DAI is dollar denominated, so it's conceptually different, yet functionally comparable to Aave and Compound. Is one superior? No. They're different manifestations of a powerful financial product and service that allows folks to capitalize on their value that they have in assets, access equity stored in Bitcoin. Um, I've showed it a couple of times in the stream, but I can show folks one final time, and this is how basically you get a 20% carry trade. So you take your Bitcoin, you wrap it into WBTC, but that's something cool. Let's show that. Let's show that. Let's show, where is it? Collateral type? Here. The rest of the list. Where is it? It got approved. It's RenBTC. Maybe it's not, it hasn't been released yet. So RenBTC got approved directly on MakerDAO, which is absolutely incredible. So instead of having to mint from Bitcoin to WBTC, which isn't a mint, I mean, technically, when you go to the WBTC cafe, you're using the Ren bridge, converting Bitcoin to RenBTC, and then using Curve to swap between RenBTC and WBTC. I think when MakerDAO releases the code to upgrade and accept RenBTC directly as collateral, that could potentially be really big. Because then you're just taking your Bitcoin going directly to RenBTC, which will have the minimized transaction fee, 0.25%. Let's go over here to the command center and see what that is. I'm pretty sure it's 0.25% still, unless they have adjusted it. 27 days till next epoch, so we just rolled on the epoch. Let's go over to the network, 0.25% on the mint fee. So you take Bitcoin, and for a fee of 0.25%, you're going to create RenBTC. And then go over to the Oasis, and RenBTC will be one of the options in the collateral. Then you mint your DAI. I highly recommend, just to remind everyone, over collateralize the crap out of your debt position. Now, bear in mind, Bitcoin has been relatively stable, sticky to the top, not depreciating in any aggressive way of late. But that doesn't mean it can't. So you always want to minimize your risk. That's what I will always talk about on this stream is minimizing risk, maximizing reward. So you want to over collateralize. Hundreds of percent. I mean, just bear in mind it's all risk reward analysis, and in the end, I said it yesterday to the blockchain babes, is how comfortable you are. You have to sleep at night. So if I take out another, if I take out another, look, if I take out another 30,000 DAI, I will have a 250% collateralization, which means if Bitcoin goes to $13,500 and we're at 19,000 and change, I will be liquidated. Which means I'll have a 13% loss plus other losses during the auction, and I could lose a fair amount of money. So is it worth the risk? And I don't think it's ever worth the risk, which is why I extensively, substantially over collateralize. 376%, the odds of me being liquidated are slim to none. Does it mean I'm missing out on potential gains? Absolutely, unfortunately. That is unfortunate, but it is real, meaning is the risk worth the reward? So as of right now, I'm comfortable. I'm able to sleep at night with my position and curve, 28.5%. The APY in the compound pool is easily able to pay the 4% stability fee for the CDP, collateralized debt position, with MakerDAO. So that's the carry trade. It means the yield here pays for the fee associated with the debt position, plus 28.5% denominated in CRV, which is emitted here on the DAO page. If you go over here and you go down here, you'll see the emission, 79%. So far, they've given me 3,000 curve for my various debt positions over the last couple of weeks at this point, months maybe. So I could claim it. I also have a vesting because I was one of the early liquidity providers to the Curve platform. So if I go over to the Ape Tax, I'm able to see it the best. So this is probably about every day and change, 148 curve a day, you know. So bear in mind the appropriate thing to do is to obviously compound, and obviously I have 3,737 YVECRV, which is going to produce 3 CRV emissions. So if I take the 3 CRV, the 3 from the VE curve that I have, and the 3 CRV from the YVE curve that I have, and I place that back into the compound pool, that's going to produce more CRV emissions, which I could then lock for more VECRV or YVECRV. Recently, I've adjusted a bit. So I could take the curve emissions and move that into Bitcoin, WBTC or RenBTC eventually, and then take out an increased leverage position, generate some more DAI, which I could use then to collateralize or provide liquidity to the curve compound pool, which generates the more curve emissions. So you're either locking your curve for VECRV or YVECRV to increase your curve emissions, or to increase your 3 CRV emissions, or you're just going to convert it to Bitcoin. So frankly, I like the Bitcoin approach. I like both. Both make sense. And the emissions should be compounded as well as converted to more collateral. Because Bitcoin obviously is going to have asymmetric returns in the coming year or so. So you want both because I think, frankly, Curve is a very speculative asset. And it's a wonderful asset that could have quite the asymmetric returns. So many farms to choose from. Where in DeFi would you put dollars? So CryptoCheck, you were talking about your IRAs. I'm not a financial advisor, but I definitely feel comfortable recommending risk off. Frankly, I wouldn't take all of the IRA and place it in crypto. And Raul has said he's uncomfortably long in crypto, but he obviously has properties and other assets, and he has a revenue stream from his Real Vision and other businesses, GMI, the Global Macro Investor product that he sells. So he's got a lot of income. The appropriate thing to do with an IRA is definitely diversify. I like gold. So with most IRAs, like a Fidelity IRA, they'll custody gold for you so you can have some bullion. Throw some ounces or a kilogram in there, depending on the size of the IRA. And at some point, commodities are going to explode because commodities are at what is it, 80-year historic lows as compared to the equities. So commodities could go up massive. You can have a 100x run on commodities. For me, the commodities of choice are uh, battery metals, cobalt, graphite, nickel, and lithium. Those are the four materials that go into modern lithium-ion batteries that will be the basis for electric vehicles over the next decade. So I think those are great. That's a great allocation for some of the capital in an IRA, especially if it's self-directed. It's much easier to manage. The bank, the gold and silver miners and streamers, Franco-Nevada, Barrick Gold, Newmont, wheat and precious metals. This basically, I'm just rambling off my equities portfolio. And then the crypto space. So risk off, Bitcoin. I reckon, frankly, if you want a great play, you don't have to take any risk. You're only into crypto. So just if this is your risk assessment. Do you want risk on assets? I have a variety of risk on assets, but you don't need it. You can make a huge amount of money just allocating to Bitcoin, and then Bitcoin you could leverage a debt position, grab DAI, and get yield. So for me, I stick to Curve because I think Curve is a fundamental infrastructure of the crypto space. But there's a lot of assets. Obviously, you have stuff like the Harvest and Simpsons Finance and all these finance products and idle finances is really cool. And obviously Yearn. And the vast majority of the time, they're using Curve and other DeFi protocols behind the scenes. And that's where this yield comes from. They're using Compound, they're using Aave, and they're using Curve and to generate this yield. And now Bancor generates yield. It has to generate yield. So Bancor is going to have BNT emissions, incentivized emissions from liquidity incentives. And if you sell those, you're able to increase your principal, aside from the interest associated with the principal itself because of the trading fees. So these platforms produce yield. So idle finance is pretty cool. I like the way their presentation is risk adjusted yield. They're going for uh, DeFi automation, and that this is the big deal. DeFi automation and what Yearn is doing and bringing it all together. This is so exciting what's going to happen in the next couple of years. I mean, this is so superior and so awesome as compared to like a bank account, which is not only just boring, it's a failure of a product. But these are just this is the next level. This is the next level of really automating everything. And tying everything together in a highly interactive and the scope and scale of what you could do with these DeFi Legos is profound. This is not, you can't do anything like this in the legacy financial system. The only thing comparable is going to like an investment broker and then managing a portfolio for you. The only difference is this is completely automated and 100% in your control at all times. So all you need is your risk assessment and how much risk you're taking with these various positions. Now, I'll always advocate the min risk, which is why I talk about Curve a lot. But there's risk on. And, what is it, that Badger that's producing a lot of yield nowadays that people are talking about? And Harvest, Seal. I don't know. I'm just pulling up a bunch of garbage. These are these finance products that people are loving nowadays. And I'm like, I don't know. Not for me. Not for me. Simpsons Finance, Seal Finance, Harvest Finance, Badger Finance. Not for me, boys and girls. I'll stick to my transaction fees. That's another thing that I could mention almost in conclusion is that when you're talking about yield, I don't want inflationary yield, and I don't really like the notion of the governance assets producing the yield too much, albeit because it's from Curve and how important and systemically important I think Curve is. So it catches my attention. But what I want my yield from is really like the yield produced by Uniswap transaction fees. Pools. Is it here? Find here. Let's see if this is it. I haven't been. Nope, not this one. The top one. I haven't been to this in a long time. Check this out. Is it pools.wi-fi? Yeah. So these are the liquidity pools. So if you go to like Uniswap V2 and you search by ROI for 30 days, all right, so they're not. Is that it? Usually there's much higher percent yields. See, here's the problem. It's the impermanent loss, and you get horrible impermanent loss with the Uniswap pools. You don't get that with Curve because they're equal value assets. You don't get that with Bancor because they have the insurance derived from the inflationary source, and you have the impermanence loss protection. So you used to be able to get some really serious yields. I don't think this user interface is capturing all the yield potential from providing liquidity Uniswap. SNX is producing 42% yield for the time being, but clearly if you have a bull run on Ethereum or synthetics, the pool is going to become imbalanced, and you're going to miss out on permanent loss. Miss out on impermanent loss. So that's the name of the game. Yeah. So I can move this over here. Look, I have 5 tabs up here that are relatively new smart contract platforms that are designed for DeFi automation. Stick to Yearn. My recommendation is if you want minimized risk and you have had the best success and the best presentation, the best transparency, and the best products built thus far, it's really Yearn and Curve. And guess what? Yearn really uses predominantly Curve. So if you notice, look, Curve, 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 Curve. This is a Curve product. It's all Curve. So it's all Curve. The best yields are from Curve. So the reason I go to Curve is I just decrease risk because there's risk associated with the smart contracts. And albeit the risk is minimized because it's Andre and Bantech, and these boys have proven themselves in many regards. But if I could eliminate greater than zero risk, low but greater than zero, that's meaningful. That's why going to Curve is really eliminating as much risk as possible. So clearly I've minimized my risk to the Curve smart contracts, MakerDAO smart contracts, and the WBTC and REN VM smart contracts. And I am able to sleep at night. As I've said, boys and girls, if you're able to sleep at night, that's really, really what you need. So yeah, crypto check. Yearn's a good deal. Yearn automates what I do. The Curve compound pool automates what I do. Except I like my yield denominated in 3CRV as well as CRV. So then I could choose to sell and purchase Bitcoin. This obviously recycles it into CDAI plus USDC, which is basically the compound pool token. If you go here and you go to Curve and you go to the compound pool and you go to deposit and you deposit, you're going to get these. So I actually have 8.9837. So 8.9837 is because I have 40 grand in this pool. And this will increase. I'll deposit it. I'll deposit 100% of it. And then I'll have Y VC die. And then I'll withdraw it. I'll have 9.1, 9.2 over the months to the tune of 13% per year. Now, it beats the crap out of a bank account. But this is where instead of recycling it into dollar-denominated stablecoins, which would be DAI and USDC, this is why the yield, I like the control of it at the Curve level because I'd rather turn that into Bitcoin because Bitcoin is going to produce the asymmetric returns. And DAI obviously does jack shit. DXDAO on Twitter if you want. They're really interesting. Here, I got 2 minutes. Let's take a look, and then we'll wrap up this stream for today. Bringing decentralized DeFi, SwapEth, Omen. Okay, so. All right, so DeFi automation, we'd have to look into them. You'd have to look into it. This is the most important thing. When you see anything new, do your due diligence. Do not jump into things. Quick to sell. picky to buy. You gotta be picky, picky, picky. Stop gambling and stop just buying. If you're buying something because you hear someone say something on Twitter, you're doing it wrong. And if you don't, and if you only buy after spending a substantial amount of time and due diligence, then you're making the right choice. Now, bear in mind, here's something important. If you don't have the time for the due diligence, or maybe you don't understand the investment, don't do it. And that's the right thing to do. And don't feel like you're missing out. It's the wrong feeling. You don't need to feel like that because owning Bitcoin alone is a good thing. And then as you understand more, you can take additional risk. But keep that risk to a minimum. Portfolio balance, position sizing, risk off, because risk off in crypto is risk on in regular traditional finance. And that's the name of the game, boys and girls. That's what I like to talk about. I hope I help everyone with these ideas. Please hit me up on Twitter if you have any thoughts or questions. Tomorrow's another day of Q&A, because that's the way we do things around here. Smack that thumbs up button. Tell everyone to subscribe. And as always, I thank everyone for joining me on my daily therapy session. I wish you all a wonderful day, and I will see you tomorrow. Peace.